So Nate, I'm going to make the assumption that the transition from home to office for most of you and your associates has been fairly smooth because you're doing everything on computer anyway, right?
Yeah, absolutely. And for me, the rest of the office is vacated, so I actually came to the office. So I'm still technically social distancing, but I'm actually here. But it has been fairly smooth transition for most people.
Yeah, I think most of you probably have not been in the Scalar offices. They are very open, so very easy to communicate, and there's a pretty interesting dynamic there. I'd say it's a free-flowing environment. Is that a pretty good way to describe that?
Yeah, I'd say so, definitely. Maybe sometimes too free-flowing. A lot of office pop-ins when you least suspect it. But
yeah, right.
Very open, very collaborative, and hopefully it creates an environment where we can all kind of learn from each other, and we definitely enjoy it. It's a great culture.
Well, and for the most part, when you're working on an engagement, it's not just one of your associates alone that's doing it. You're doing it as a team, correct?
Yeah, for the most part. We do have people that we would say like an individual technically leads evaluation, but we do have people that are working separately on like inputting all the financials and the capitalization table and things like that. And then there's a review process that we go through and make sure we bounce ideas off of each other. So there's definitely collaboration there and making sure that we reach an internal consensus on the results before we send anything to a client.
Well, very good. Well, thank you, Nate. I see that Zach has joined us. Zach, we apologize for having kind of messed up your schedule this morning, but are grateful that you're willing to host us, if you will, for a little bit this morning.
Absolutely, and it was me that made the mistake. So apologize about that, Rick. It's been a good busy day here. So happy to chat with everybody, though.
Well, very good. So Zach, the students that are with us, as you might recall, are students that have already gone through our investments course, our 2 corporate finance courses. A couple of these students are part of the university evaluation group. They understand what I would say is the basics of valuation. And this course is an advanced valuation modeling class where we've gone ahead and dealt with some of the esoterics. We're about to deal with Monte Carlo simulations. We've done Black Scholes. We've done the blue sky model. And then we worked beyond the academics where we could easily find free cash flow to the reality to just say, well, we're going to figure out what some cash flow is. It's probably going to be called seller discretionary earnings. And so that's kind of where they're at. They understand cap tables and dilutions, but we still are in the academic environment, whereas you are in the trenches. And we appreciate you being willing to share some of your company and some of your thoughts with us today.
Yeah, and I appreciate that, Rick. And just kind of setting the stage, as you get into more complex financial instruments, I've asked Nate, who's one of my partners, to join the call. Nate oversees our complex financial instrument practice. And so he's constantly working on valuing embedded derivative instruments, forward contracts. He works with the Bi-Nomial Lattice model and a Monte Carlo simulation literally on a daily basis. And so while I could stand up here and give you guys a brief overview of those models, in full disclosure, it would be I wouldn't do it justice, and I think the amount of depth that you're looking for, I felt that Nate would be a much better participant to help us with that. So with that being said, Rick, I am happy if we want to jump right into meat and potatoes. What we typically do from a presentation standpoint, and Nate has this, is we basically talk about the difference between a Black-Scholes, a binomial lattice model, and a Monte Carlo simulation, and how those 3 are different, and how we use those 3 in a real practical world when we're looking at valuing different securities. So I've asked Nate to share. We have a model that we can share and describe what the difference is, and I've asked Nate to help us with that. So But before we go there, and Rick, maybe I'm jumping the gun on your agenda, but if there are any valuation questions or you'd like me to address anything from a career evaluation, I'm more than happy to do that. But as we jump into the presentation, unfortunately, I'm not going to stay. I have a handful of pressing engagements that have come up this morning that I need to address. So, but I'm happy to talk through any questions anybody has before we go into the presentation.
Well, thank you for letting us know that. And we certainly understand it, Zach. Maybe before you leave, you're always excellent at giving a higher level understanding of your firm and this industry. So if you want to take a couple of minutes and do that, a few of our students on the call have met you and know your firm, but for the most part not. I mean, they know what I've said about your firm, and it's always good, positive things, of course. And but if you could kind of, no, really it is, Zach, I promise.
I know. I just can't help but smile. Thanks,
okay. But if you can kind of give them the higher level scalar overview briefly before you go ahead and jet off to your other engagements this morning.
Yeah, happy to do that. So, so Scalar, who are we? We are a pure valuation firm. What does that mean? We do valuations for really 4 primary purposes. We do them for tax purposes, we do them for financial reporting, we do them for transaction advisory, and we do them for litigation. And I'll be more specific. So in the tax world, where do we get involved? We get involved in doing a lot of what are called 409A valuations or profits interest valuations. If you think about a startup technology company, a startup life science company, or even a growth firm that is issuing, or these are privately held companies issuing equity to their employees, ultimately they have to come up with some underlying value for that security which they're issuing as deferred compensation. And so those companies look to a firm like Scalar. We happen to be one of the largest firms, in fact, we're the second largest firm in 409A valuations and deferred compensation valuations in the country. So as you look at issuing those types of equity instruments, you need to have somebody value those securities. And so Scalar, we're one of the preferred firms to do that across the country. In fact, internationally, we have a fairly large Canadian practice as well. And so what does that look like? That's using your traditional valuation methodologies that Rick's teaching. So we're looking at income-based approaches, market-based approaches, and then we use equity allocation methodologies. Some of those are like a Black-Scholes or a probability-weighted expected return. And Nate can talk about some of the more sophisticated, like a Bi-Nomial Lattice model or Monte Carlo simulation. So on the tax side, that's one of the valuations that we do. Other tax valuations that we get involved with is when entrepreneurs and high net worth individuals start making investments in privately held companies or privately held funds. As they think about their estate planning, they start moving their ownership interests into trusts. And so as they do that, they need to have a valuation done. And so we come in and help those individuals do that. And that's actually, I apologize, this is the reason I was late. I was on a call with a client in Florida who owns a privately held mining company in Romania, of all places, and he's transferring those interests into a family limited partnership. And so that's on the tax side, the type of work that we do. On the financial reporting, we have a fairly robust portfolio valuation. So if you are a private equity fund, a venture fund, a real estate fund, a hedge fund, any type of alternative asset manager, you typically, most do this, they do what's called mark to market. So you probably are familiar with that, where you come in and you value the underlying equity value, or if they hold debt, the value of the debt that they own in these different companies or asset classes. Our niche is working on level 3 assets. And so we're valuing privately held companies that are held by private equity firms, venture funds, hedge funds. In fact, one of my new clients is a hedge fund based out of LA that's making investments in life science companies now. And we come in and we value their underlying holdings on a mark-to-market basis, either quarterly, semi-annually, or annually. And so that's some of the financial reporting work that we do. On the transaction advisory side, think fairness opinions, think mergers, acquisitions. We're not an investment bank, so we're not brokering transactions, but once a transaction's being discussed or negotiated, oftentimes an investment banker may not be involved, but they still want a third-party valuation to kind of, give them that arm's length validation of a purchase price or a sale price, et cetera. So we get involved with those as well. And then the fourth thing we do is on the litigation side, primarily is shareholder disputes. And so unfortunately in the world of business, you know, a lot of founders will get together and they raise money from investors. And when things go poorly, oftentimes it leads to litigation. And so when that happens, people typically sue over what's the underlying equity value of their holdings in a company. And so we get involved and we help there. So all of the things that we do from each one of those four buckets all comes back to what Rick teaches in his classes, which is, you know, what's the underlying value of a security? What's the underlying value of a company? So, you know, when I was in college, we used to talk about it and we'd say, hey, you know, are we ever going to use this stuff that we're learning? And, you know, I think that the reality of it is the stuff that Rick teaches, the information he's conveying to you is absolutely applicable in the world that we play in. And we deal with it every single day. And so what is Scalar? You know, I have a better way to put this is, you know, if you look at Scalar, we're 50 people. We do about 150 valuation engagements a month. Put it in perspective, last month we did 202 valuation engagements across 50 people. So I know Barrett and Cameron who joined, they're both alumni of Westminster. You know, they manage at any given time anywhere between 30 and 40 companies on their plates that they're doing valuation work for. Now that doesn't necessarily mean you're valuing 40 companies all at the same time, but you may have 10 engagements that are active, 15 engagements that you're waiting for information, you know, another 15 engagements that may be on hold for whatever particular, you know, a board approval, waiting for an auditor, et cetera. But you're managing a fair amount. So as a valuation professional, not only do you have to be skilled in Excel, not only do you have to have your really core understanding of finance and the valuation methodologies, but you have to be a great project manager. And then the final thing that really is an underrated skill set, but something that's incredibly important, is your ability to communicate, both written and verbally. So if you can't write really well, if you're trying to convey something that's very technical and you struggle at writing, that's hard to be a really good valuation professional, because you end up not getting the message across that you'd like. And the same is true as it relates to verbal communication. Oftentimes we're dealing with complicated financial models, and Nate will talk about this as he talks about the Monte Carlo simulation. If you struggle to be able to explain what you're doing, you know, people sometimes will be like a deer in headlights. And so other great skills that you should be, you know, honing in while you're at the university, your ability to write, your ability to communicate verbally. You know, career evaluation, I'll just touch on this briefly. Career evaluation, in my opinion, there's no better place to launch a career. And I'll tell you why. One, you're developing a hard skill. I graduated in economics from the University of Utah. And while economics is a great, it gives you a great basis of what's going on in the world, it's not a hard skill. And for every rule in economics, there's an exception to that rule, you know? And so it's technically at the University of Utah and many universities, it's not even in the business program, it's in the social science program. So it's in the same program as psychology, anthropology, and so they have economics there as well. So it's a great, so when you come into finance, as you're studying finance and you come into valuation, you're going to develop a hard skill. And that hard skill, honestly, is very transferable. In finance, across all finance, whether you're an equity analyst at a large fund, whether you're working at a private equity fund, a hedge fund, real estate, whether you actually go work internally in a company as a CFO or an FP&A analyst, everything we do, that skill that you have will be incredibly valuable. If you look at our alumni where they've gone, if they've gone to hedge funds or private equity funds, or they've gone to start businesses, they'll all come back and say, man, if I think back about what I learned at Scalar, it was really the core foundation for my career. And we have our alumni now are sitting at, you know, private equity funds, some are in corporate development at Salesforce, you know, and so all of that kind of comes back to what they've learned here at Scalar. And so what I usually tell people is, if I'm looking at a career, whether that's in anything in finance, I want to get a career in finance. I want to start my career at a job, so to speak, or within a vertical in finance that's going to give me a hard skill. And that hard skill is really critical to, you know, really be the basis for your career. So that's kind of, I've talked, I don't know, for 10 minutes or so. I'll take a breath there. And anybody have any questions, comments about Scalar, what we do, or, you know, a career evaluation?
This is your chance, guys.
What type of company do you find the hardest to evaluate or the most challenging?
It's companies with not that much data tend to be the ones that are the most challenging. More established businesses that have cash flows, or even if they don't have cash flows, but they have significant revenues, they tend to actually be an easier valuation because you can use more traditional valuation methodologies to hone in on a number. Where conversely, if you're an emerging startup company or emerging, let's say you're a life science company and you are in the petri dish stage, what's the value of that company? Because it's fairly binary, and that can be a challenge to value. The same as mining companies can be hard to value as well, depending on, again, the access to information and data you have available. But those are kind of the real critical things when you're valuing your company, is like, what is the data you're receiving, and really how good is the data? So that's really what's going to determine if the valuation is going to be difficult or not difficult.
Besides giving your advice, besides offering your services, do you ever try to advise your clients on other financial like options that they might want to look into, maybe to further advance their business or something like that? Do you ever do something like that for your clients?
Yeah, we don't get involved per se in like consulting projects like you would be engaged with to say, hey, what are strategic alternatives to our business? We don't get involved in that side of the business. Where we are involved is almost always related to either a transaction that's in place. So we may be involved in, hey, we're thinking about, Barrett, for example, worked on this with one of our clients that was just recently acquired, where they were thinking about acquiring another company at the time before they were acquired. And we were involved in doing all the financial modeling and helping make the argument to the seller why they should do the deal. But we don't post that engagement. We don't get involved and say, okay, here are other alternatives that could be beneficial to your business. I think that probably leans more into more of a true consulting role versus like a valuation role.
Thank you.
Well, Zach, you're always very generous with your time, and you become a good friend of our program. We're very appreciative of that. We respect that you need to get off to some other priorities and engagements. So we'll let you go, and we'll go ahead and turn our attention to Nate and then my friends Barrett and Cameron. But thank you so much for joining us today, Zach, and let us visit with you. Absolutely. Thanks so much, guys. Really appreciate it. So Barrett and Cameron, if you would just briefly introduce yourself to these students. I think you probably know a couple of them, but most not. Barrett and Cameron both came out of our finance program, 3 years ago or so, and have been with Scalar ever since then. In fact, I think, Cam, you even joined Scalar before you graduated, if I recall correctly. So Barrett, say hi to us for a moment, and Cameron, if you would, and then Nate, I think you probably have some things to share with us.
Yeah, good to be here. Sorry for the delay. Yeah, as Rick said, been with Scalar since 2017, and always happy to come back and talk at these things or in classes. I've met a couple of you through that, and yeah, I'll turn it over to Nate and Cameron.
Hi, Cam.
I joined Scalar pretty much 2 days after my college graduation was my starting day, that following Monday. But interviewed kind of for an internship while I was attending Westminster. So that was kind of the time frame. I actually interned as a graduate, hopeful with the expectations of getting a full-time offer. And so after I graduated, I was a summer intern and then got a full-time associate offer, and I've been there ever since. So
you guys should all know that Barrett and Cam have both also been a couple of the professional mentors that have helped us with preparing our evaluation teams as we go to Atlanta. I'll certainly be inviting them to do that again this coming year, and hope they'll be in a position to join us again. I think, Cam, you were in the very first semester of Finance 309 that I taught. And Barrett, I don't recall if you were in that first semester or one that followed it.
One that followed.
That's what I thought. And Cam, I'll just apologize now because I knew a little bit, I've learned an awful lot about some of this in the interim. My sense is you've probably learned more, and I'm proud of you for that, of course. But I hope I didn't twist it too badly here, brother.
No worries.
Okay. So Nate, if you, I think you have some things to share with us, and we're all ears.
Excellent. First of all, how much time do we have? I want to be mindful of everybody's time.
You know, we want to be respectful of your time, Nate. I had originally indicated to Zach we'd hope to maybe spend an hour or so with you guys all in. And if that, you know, sadly means we've got another half hour or so in front of us. If that works for you, great. If it doesn't, we're certainly going to be respectful of that.
Yeah, sure. Yeah, I should be fine on that, and hopefully I won't run over. Now, also for just to give me some additional background on what you guys have been through, you mentioned that you covered Black-Scholes. Have you talked about binomial lattice models?
We have not talked about binomial lattice models at all.
Okay.
And we are preparing to have our discussion with respect to Monte Carlo simulation. And I would tell you that maybe a third of the students have a decent working knowledge of it, you know, higher level knowledge. I don't think they could run you through the math, nor could I, by the way. And I think the others don't. And in Black-Scholes, I think we got a pretty good lesson on that, and we've actually done some assignments with Black-Scholes in motivating the model and such. But you know, you're welcome to discuss it with us further. You might dispel some falsehoods that I allowed to get in here inadvertently.
No, I'm sure everything was great. I'll start off probably with the Black-Scholes, more just for a quick review, and so that I can illustrate that in comparison to the other models. And if at any point anybody has any questions, you know, feel free to chime in. What I'm going to show you is, you know, I'm going to show you three types of models, all used for valuing complex securities. So we'll look at Black-Scholes, we'll look at the binomial lattice model, and then we'll look at the Monte Carlo simulation, and then we will look at the reasons why you might use one of those over the others. And we'll actually be looking at real engagements that we worked on, or we'll say cases based on real engagements. And you know, hopefully through this, I'll be an example of what Zach said when he talked about your ability to communicate clearly. Hopefully I won't completely dispel that.
Well, he sets a pretty high bar there himself.
Yeah, he did. Yeah. He set it a little too high, I think. So hopefully this will be good. But again, you know, feel free to jump in with questions as you have them. And yeah, without further ado, I'm going to share my screen. Can everybody see this Black-Scholes calculator okay?
Yes.
Perfect. Okay, so simple Black-Scholes. We've got all our inputs to the Black-Scholes. This is the stock price at time 0, so today. The K is the exercise price, sigma is the volatility, T is the time until maturity on this particular option or warrant. I'm going to hide these ones for now. They'll come into play later. You have the risk-free rate. You have a dividend yield. In this case, the stock we're looking at doesn't pay dividends. We have our intermediate D1 and D2 calculations. We talked about those a little bit. If you want, and then there's the ultimate value. So here we have a stock price of $2.20. We have an in-money option at this point. It's in the money by $1.20, but the value of this option is worth more than $1.20 because we have some potential over the next 5 years that this is open, and considering, you know, the volatility of the stock, we have potential that the stock price is going to climb even higher over the exercise price. And of course, there's also probability that the stock price could go down, but as you recall with options, the payout is, there's a floor of 0 on the payout with options. Or with call options. So that everybody's familiar with?
Yeah, in fact, Nate, are you using the European exercise construction
Yes.
here, or okay, that's what we supposed.
Yes.
And this of course is the call. You don't bother valuing puts at all, right?
We will do puts for some cases. In fact, that's probably a good it's probably a good thing to talk about. So one of the things that we do actually use put options for, and specifically the Black-Scholes European put calculation, is for a discount for lack of marketability. So one of the things that we deal with on a lot of the private companies that we value is that the stock is not marketable. So we might come up with a valuation of the stock on a per share basis, but that's often based on comps, and those comps are readily tradable. They're very liquid, and relative to those types of comparable companies, it's probably going to be pretty difficult for a holder of like one share of common stock in a private venture-backed company to actually liquidate their position. And so in addition to the value that we might come up with, we usually apply a discount for lack of marketability. And the theory behind the discount for lack of marketability is this. If you were, well, let me see, how do I phrase this? Essentially think about what a put option does. Right? It gives you the right to sell a particular security at a specific price. And you'll exercise that, as soon as it becomes advantageous to do so. One way that you can look at a put option is that because it gives you the right to sell, you have in effect purchased a right, you've purchased marketability for that security in effect. So if you buy a put option on a non-marketable security, that in essence makes that security marketable. So the theoretical cost of the put option would be the degree to which you would actually discount that stock. So that's something that we do use the European Black-Scholes put in order to appropriately quantify, what somebody should be willing to pay to effectively purchase marketability for that stock, and that then ends up being that discount for lack of marketability. So that is an area where we do use the Black-Scholes put. So, any questions so far?
Nope, we're good.
Hopefully that made sense. Okay, perfect. Let's jump into a lattice model. I'm going to unhide a few things here. Now, we have some additional inputs. The idea of a lattice model relative to a Black-Scholes is Black-Scholes is using this continuous distribution, log normal distribution of stocks or normal distribution of returns in order to quantify the present value of all possible future payoffs of the stock. The difference between that and a lattice model is that the lattice model is doing it, rather than doing it looking at a continuous distribution, we're actually going to look at discrete steps of what the stock price can look at particular points in time going forward. And they call it a lattice because it kind of branches out like a lattice model. So the other inputs that are important to know is based on volatility, we're computing some kind of an upward movement factor. We know that the stock price has to either go up or it's got to go down. It can stay flat, but really, it's going to go up or down. And those are our primary possibilities. And then there's some probability that it's going to go either up or down. And we want to basically limit, or we want to constrain those possible movements by the volatility of the stock. So the more volatile the stock is, the higher, the more it can move up and the more it can move down. And that's that kind of helps illustrate why a higher volatility stock is going to have a greater option value for an option on that stock than a security with a lower volatility, because again, you have more potential for the stock price to move upward. So we have our upward movement factor and our downward movement factor. That's based on volatility, and it's based on volatility. It's based on the volatility movement constrained to a small period of time. So rather than looking at a full time jump, we'll say from time 0 to time 5, we're going to look at discrete steps in between. In this case, this particular lattice model, this is the N figure here. We have a 300 step lattice. In some of the examples that you would probably go through in some of your courses, you would probably use like, maybe a 3, 5, or 10 step lattice. I've specifically chosen a 300 step lattice here to illustrate something interesting, which I'll get to later. But basically, dt, this is a delta t, or change in time. So every step that we look at in our lattice is going to represent 0.02 years. So our upward and our downward movement factor is the degree to which the stock, based on volatility, the degree to which the stock is going to move either up or down over 0.02 years. Everybody with me so far? Perfect. Okay, then P star, this is another important input. I'm sure something you probably discussed about Black-Scholes is that it's all kind of rooted in this framework of risk neutrality and no arbitrage. We can basically, this is a little difficult to explain, but basically P star is what I usually refer to as variable, but this represents the probability of an upward movement of the stock given a risk neutral framework. So if we can kind of, it probably would have been helpful to actually walk through solving this formula, because it's actually kind of useful to illustrate how it works. But if we were to say, if we invested today at the risk-free rate and we knew our probability, we knew that the stock was going to go up or down, and there was some probability associated with the stock going up or down, what would that probability have to be in order for the future value of our investment to equal the probability weighted possibilities of our future investment at the end of that point in time? So that basically says that regardless of whether we invest in a risk-free asset or stock that has some probabilities of moving up and down, the value of our portfolio at the end of the time is going to be identical within this risk-neutral world. I know that was very convoluted, but I hope that makes some semblance of sense.
So Nate, as we would read that P star, is that a 49% probability of an upward movement, which would then mean a 51% or less probability of a downward movement?
Correct. Yep, that's correct. Okay, so let's start with the lattice. So this is doing the same thing, using the same inputs as that the Black-Scholes model. So our stock price is 220. A movement to the right represents an upward movement, and then a movement down and to the right represents a downward movement. So this is up, 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 and down, 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 or alternatively down, up, down, up, down, up, and so on and so forth. And you'll notice that a down and an up gets us right back to the original stock price. That happens to be the pattern you're always going to hit. You're always going to come back to that 220. But the purpose of this lattice is then using those upward and downward movement factors, we're looking at what can the stock price look like based on that change in time that we had looked at previously. It looks like it's actually a little less than 0.0167 years for each one of these. So by the time we reach, 3 months out, we're looking at this possible distribution of stock prices. Remember, we've gone out 300 steps. So if we scroll all the way to the end of this lattice here, out of the 5-year mark, we're looking at a possible stock price here of 565 million, which that's going to raise some red flags for some people. This is one share of stock. One share of stock is never going to be worth 565 million. I mean, maybe Berkshire Hathaway one day. But the important thing to note is that this is all based on probabilities. And so this is, 0.49 probability raised to the 300th power. So it's going to be effectively 0. So even though we're seeing a really large stock price here, this is not, when you consider the weighted average of all possible stock prices, this is going to receive very little weight in the ultimate distribution. If I scroll out here, though, you can see kind of how many instances of the stock price we're actually simulating within this lattice. It's a lot. And it doesn't actually illustrate effectively how many there are, because some of these paths are kind of overlapping and converging. You know, if you have one stock go up, up, and then down, you effectively, there's a completely different stock price path would go down, up, and then up. I think I said that right. And you would arrive at the same. You would arrive at the same node. They call each one of these instances a node. You might arrive at the same node, but it may have taken multiple actual paths to get there. So that's kind of an important thing to know when we're going to consider the advantages that a Monte Carlo has over a lattice. Is that the lattice doesn't give us an individual stock price path. It gives us sort of a convergence of possible paths within each node. So the first step is then to forecast out the stock price by looking at the volatility all the way to maturity. And this is, again, looking at things in sort of the European model. So we're assuming they can't exercise until maturity. So what we want to do basically in our option lattice, this is where we're actually doing the valuation. Whereas the stock lattice works forward, starting with the stock price and ending at a possible distribution of prices, the option lattice is going to work backwards. So the first thing we're going to do is compute the payoff. You can ignore the if statement here. Really, the key is, what is an option payoff? It's just the maximum of the difference between the stock price and the strike price, or zero if it's out of the money, because it's not going to exercise if it's out of the money, right? So it's going to be, you're going to have a floor of zero. So all we're doing for each of these is calculating the payoff based on the corresponding stock price from the other tab. So that minus the exercise price, or zero if it happens to be lower. So we're not going to see any negative values in this lattice. So that's the first step. The next step, we're basically going to discount. We're going to do a discounted cash flow, but we're going to do it one step at a time, and we're going to probability weight the discounted cash flow based on that probability of an upward or downward movement. So if we look at this, and actually it looks like this model is set up to do a European option, but in this case it won't make a difference. But the important part is probably this this next piece. Can everybody see the highlighted formula okay, or is that a little too small?
No, we can see it.
Okay, perfect. So this is continuous discounting. We're discounting at the risk-free rate by one step, one time period. And what we're discounting is the probability weighted average of the future nodes. So we have either an upward or a downward node that are right next to it. What is our payoff in the up node? The probability of the upward movement is our P star, and then 1 minus P star, that's our probability of the downward movement multiplied by the downward movement that we observe at one point in the future. So putting that together again, it's the probability weighted average price in the future, one step into the future. Again, it can just go up or it can go down from any particular node. And then we're discounting that by one step at the risk-free rate. Okay. And that's what we're doing in every single one of these nodes, actually. And if we do that, every time we back up, we're going to lose one instance. So basically, this is going to start to converge. If we walk it all the way back using that same process, eventually we're going to arrive at the theoretical value of this option. That make sense?
Well, to our limited exposure, kind of. But
Okay.
Probably about as much as you're going to get in our thick little skulls this morning.
Okay. And I apologize if anything is unclear, and I'll do my best to try to make anything more clear. But
Well, you're a pretty smart guy. So,
You know, I fool people. So, you know, again, let me know if there are questions, but one important thing to note is, so because I've used 300 steps here, this is starting to look like a continuous distribution. There are discrete steps here, but they're small enough time periods that this might start to actually look continuous. You know, if you look at a continuous distribution, if you draw small enough lines in between that continuous distribution, you know, eventually you can come up with steps that are small enough that it looks approximately similar. So the theory says that the more steps we use, the closer that this should actually approach a Black-Scholes conclusion. So if we look at the conclusion here, a $1.49, and compare it to our Black-Scholes conclusion, in fact, I've got this, there's how close they are.
so given that, what's the value or virtue of going through the lattice structure when you get such convergence on what the Black-Scholes offers you instead?
Yep, excellent question. So one of the benefits of looking at the lattice in discrete steps is that you can manipulate what's happening in each one of those steps. So something that might happen is an exercise price might change. So I actually have a perfect example of this, and this is a real world scenario where the exercise price that a company had on their option actually increased every year. And you can use a lattice to sort of to account for that. Another issue is that, say that there is a put option and a call option on the same security, you can look at you can sort of look at the interplay between those options and how they might affect one another. So for instance, say I have a call option and maybe the call option is an American call option. And so I can exercise that at any time. But then there's a put option that's a European put option. Well, if I'm short the European put option, but I'm long the call option, if I exercise the call option, then the other holder of the put can't exercise their put. So that actually reduces the value of their put position. And a lattice model allows me to sort of capture for that. The other thing it allows you to do is to set constraints a little bit better. So what I mean by that is if you said, if I were to ask you the question, I mean, I have a better example of this, but if I were to ask the question, an option on this particular stock is, now actually, let me backtrack on that. I'm just going to go to the example because I think it'll actually help illustrate a little better what I'm trying to explain here. So that was a lattice. This is a messier lattice, and this is again based on a real world scenario. It was based on an investment of one of these security companies. I can't say which one, in another security company. And what they did is they acquired 20% of the company, but along with their acquisition, they also purchased a call option. So they got the right to purchase the remaining 80%. On the other hand, they also received, or they were also short a put option. So the company, the other 80%, had a put option that they could sell. They could sell to the investor if they so chose at any point, and that kind of creates a scenario where this company is going to end up with the shares no matter what. If the stock price falls pretty low, they're probably going to exercise the put option, and these guys will have to buy the other 80%. If the value gets really high, that's going to make the value of the call option look really good, and so the call option, they'll likely exercise the call option. And there might be some situations where it might not be advantageous to exercise. And in this case, I think it's always advantageous for one of them to exercise. But so let me kind of go through the terms again. They purchased 20% of the company. and they received a call option to purchase at these exercise prices, the remaining 80%. So $140 million for the first year, and then it suddenly increases to 160 million. Oh, sorry, 160 million. I think it's after 1 year. Yeah, right there after the year mark, it goes to 160 million. And then our exercise price jumps up to 180 million. And then I think, it remains flat at 180 million until maturity. So every year increases by $20 million if they don't exercise previously. And then the put option has a $125 million exercise price. So they would be required to pay 125 million if the stock price fell below such that we're looking at aggregate values here. If the aggregate value of the stock fell below 125 million, that put would be exercised and they would be forced to pay it. Okay, this is a messy model, but there's one additional step here that is why we needed to do the valuation, is that at the same time that they did this, they granted restricted stock to employees. And the entire purpose of this is that we had to figure out what is the value of these restricted shares that they granted to the employees, and could we figure that out based on this investment value? So we have a few pieces of information. We know that the company invested $25 million. We know for $25 million, they purchased 20% of the company in stock. We know that they received a call option to acquire the remaining 80% of the company. And we know that they're short a put option to purchase the remaining 80% of the company. And for all of that, that put value is an offset to them. Being short a put is sort of negative value that they acquire, so that offsets the rest of their investment. So the value
and Nate, before you move on, I want to make sure that the students understand what restricted stock is, because it's not clear to me that they necessarily all know that. Restricted stock is stock that is given or granted, provided to a shareholder, but they cannot transact it for at least a specific period of time, depending upon the restriction placed upon it. So they own it, but they can't do anything with it until some point in time.
Yep, absolutely. So given those constraints that we have, we know what they purchased, and we know that the aggregate value of their investment was $25 million. That's what they paid for it. And this is where the lattice is actually really useful, is that we can set all of these things, we can value all of these things within a single lattice, and then say we can solve for the implied value of the stock, and this isn't a publicly traded security. We can say, what does the value of the stock have to be in order for the value of their investment to equal $25 million? So this, it looks a little messy, but it's effectively doing the same thing that other model was doing. It's just doing it all in one big lattice instead of separate lattices. So the stock price here is working the same way. It's working an upward movement. The next cell is, the cell to the right is an upward movement. A cell, the same corresponding cell downward and to the right is a downward movement in stock price. So the stock price is working forward. The callable share value is just the aggregate value. So it's whatever the per share value is multiplied by the number of callable shares, which is 165 million shares. So that's the aggregate value of the stock. And then we have the call option value and the put option value. Same with the other models we were looking at. Those ones are starting at the payoffs and they're working their way back. In this case, though, the only difference would be the call option is an American call option. So we account for the point at which that would exercise early. And you would actually find that it becomes advantageous to exercise early anytime there's an increase in the exercise price. And then there's the put option. The important thing about the put option is that by including both the call and the put in the same model, we can capture the fact that if the call is exercised, the put cannot be exercised. So this allows us to account for that. And again, the payoffs are calculated maturity, and then discounted back on a probability weighted, one step at a time, all the way to convergence. And then once we get to this point, the stock price that I plugged in here is entirely arbitrary. I just plugged something in so that it would work, but I need to come up with a $25 million value of the investment. So I just set up a solver function and said, change the stock price. That gives me a $25 million investment. We got pretty close. Oh, it's getting closer. Well, we're pretty close anyway. So there's about $25 million. And it just turns out that the value of the stock based on this investment must be 76 cents in order for the value of this investment to be equal to $25 million. So that's a lattice model. That's a pretty unique case for when a lattice model is useful. It could be done in a Monte Carlo, but it would be very difficult. You have to kind of iterate into the conclusion that gave you that 250 or the $25 million conclusion. But this way you can just kind of run a solver and it all kind of converges nicely. So lattice was very useful for that scenario.
Nate, is there still value in using a model like this when, like in the current market environment, when there's so much volatility and so much of it is uncertain?
That's a good question. The answer is probably all evaluation models are wrong. That's one thing that we know. However, there are specific guidelines that you have to sort of adhere to in order to ensure, comparability across firms. So when we're looking at any kind of investments in public companies, especially, you have to make sure that they're comparable. So you can't have a valuation professional using, one type of model for one company and then another one saying, we don't think that that works in this environment for X, Y, and Z reasons. There's got to be, I guess, what I'm trying to say is there's got to be consistency in how people are approaching their fair value estimates. And I think, so we're constrained, I guess, by the industry accepted models that we have available. But we would consider the recent volatility of the market in how we're approaching the valuation. So for instance, we did a valuation recently for a company that they granted performance-based stock options. So that basically says if you're the CEO of the company and you have these performance-based options, if your stock price climbs to X price, then you get a bunch of shares or something like that. And so it provides incentive for the CEO to help grow the stock price. If we have something like that before the COVID-19 stuff, we were looking at the historical volatility of the company and it was pretty stable. We were looking at like maybe 20% volatility. But then after the COVID-19, the last few trading periods, it looks very volatile. And it had to be something that we, this is a long-winded answer, I'm sorry, had to be something that we considered in the analysis. Could we say that the recent volatility was indicative of volatility going forward? Maybe not. However, we would expect there to be recovery after everything kind of ends and everything opens back up. And for that reason, we consider the higher volatility appropriate, because again, that's going to push the value back up. And we thought if we didn't use a higher volatility, we're not going to account for the possible rebound in the market once everything comes back. I hope that made sense. I hope that answered your question.
Yeah, thank you.
Sure. Okay. Looks like we still have a little bit of time for Monte Carlo.
Yeah, we have more time than we probably want to abuse with you. So you've got a little bit of runway in front of you if you'd like to use it.
Okay, I've got some more time. So I've actually got about 30 minutes before I have to jump on another call. So
well, and there's a couple of students on this call that are particularly interested in what you're about to say. that would be Pat and John, because they're the ones that are responsible to walk us through Monte Carlo. So you're about to do them a 5-star favor, and if they don't send you some kind of a gift, I think it's a tragedy.
Well, you know, that'd be great. You know, you don't have to. I will say there may be a difference in my experience, the way that Monte Carlo simulations are approached in academic setting. It's usually, and this is very useful. It's a very useful thing. Often there's, you know, you might be looking at a discounted cash flow and say, what if we look at some possible distribution around the growth rates that we're assuming, and then we want to run, you know, 1 million separate trials to see, you know, based on some range of outcomes for the growth rate, what could that look like for the payoff on our discounted cash flow? This is similar to that, but this is using Monte Carlo specifically in the context of an option valuation. So it's not as useful from the approach of like a robust sensitivity analysis. This is more, how do we use the randomness of a Monte Carlo distribution and simulation of possible stock prices to value an option. So I hope that's clear. It's a little bit of a difference. My guess is that Monte Carlo types that you'll be discussing are more in line with like a robust sensitivity analysis, which is still very useful, and it's stuff that we do for a lot of different valuation types. But the basic idea with Monte Carlo is instead of looking at the discrete one step at a time stock price projections, we are going to simulate one single path at a time. And we're going to simulate basically and we're only going to look at one point in time. So what does the stock look like based on the volatility, based on all of the same inputs as the black Scholes? Basically, you can ignore all of the lattice inputs, like the number of steps and the change of time. That's not relevant for this. And the up and down and the Q-star, those are not relevant either. Same inputs as the black Scholes is really the key here. So given our volatility, and given that this is a 5-year option, we're going to say, what could the stock price look like at the end of that 5 years? And the mathematical approach that we use to simulate that is known as geometric Brownian motion. I don't have too much time, and nor do I think I'm qualified enough to go into the intricacies of geometric Brownian motion.
And they're probably grateful for that.
Yeah. So this is, I'll just say that this is the secret sauce in order to simulate something so that it gives results that are consistent with what the other models would give you if you were looking at it, evaluation in the same way. You can see we start basically with the initial stock price in the formula, and we're applying a growth factor to it that includes it includes some volatility estimates, it includes some risk neutrality with risk-free rate investment, and it includes a random variable as well within a normal distribution. And that's considering that this is our stock return, and returns are normally distributed, but prices are log normally distributed. So this should give us a log normal distribution of stock prices if we were to actually cram everything here into a distribution. So basically what I'm doing is each one of these trials you see just represents one instance of a simulation. What is one possibility of what this stock price might look like at time 5. Then I'm saying, based on that simulated price, what is the present value of that option? And all I'm doing is taking the payoff, same idea, the maximum of the stock price that I've simulated, minus the exercise price, or 0 if it's out of the money, and then I'm discounting it based on continuous discounting it to and I'm going to do that many, many times. So best way to look at this, I think, there are 10,000 trials here. We're actually going to do 1 million trials. And Excel is not going to be very good at calculating 1 million separate trials. But what we're going to do is trick Excel into doing that by basically doing 10,000 trials 100 times. And that will be, if we take the average of all those conclusions, that's effectively identical to taking 1 million separate trials. So that's how we're going to approach this. So best way to look at this is that one single instance, every single formula is the same. It's just going to give us a different result due to the randomization. So what's a possible stock price like at maturity? What is the present value of the option if that stock price occurs? If I press F9 repeatedly, you'll see how these are randomized. And you'll see that I'm getting results kind of all over the place. Similar to that lattice model, we're going to see some high stock prices that are probably outside of the realm of reason, but there's pretty low probability that some of these things are going to occur. So once we kind of average everything out, we're going to see a good convergence. And you can see even right now, what I'm doing is I'm taking the average of all 10,000 trials, and that's giving me, so one instance of 10,000 trials gives me the average of $1.46. So you can already see we're kind of getting pretty close to what the Black-Scholes might indicate. And so what we're going to do, again, we're going to run this 100 times. I think I have this set up to 100. Let me double check. Yeah. I did 250. Just do 100. Okay. All right. So this is just a relatively simple. I think for the type of Monte Carlo that you might be looking at for doing like a very robust sensitivity analysis, you might be looking at like an at-risk or risk amp kind of software to help with those distributions. In this case, all we're really doing is where the simulation is really occurring within the randomization in the formula that we've already built in. We just want something that's going to grab every instance of the 10,000 trials. So all this macro is doing that I've just written in VBA is pretty simple macro. Is it's just taking the value of this one instance, it's going to copy and paste it below, and then it's going to refresh everything and then take the new instance, copy and paste it below, so I get results for every single instance of 10,000 trials. I think that is the right one. Let's see. Sorry. I like to see it running, and sometimes it doesn't let me see it. There we go. All right, so it's kind of doing its thing. It's cranking away. As soon as this gets to 100, we'll look at the results. So you can already see we're kind of getting a good convergence just with each instance of the 10,000 trials. After we take the average of all of these, there you go. That's the result of 1 million trials. It says 2.5 million, but I just did 1 million. Pretty close to the same as your other methods. So then,
do you ever use the Monte Carlo or the lattice to estimate something other than an option value?
Yeah, so we will do a Monte Carlo more along the lines of what I think you would see with like a sensitivity analysis. So we might do a Monte Carlo simulation for like a pharmaceutical company, and maybe we would put a normal distribution around like a success rate for a clinical trial, and we might see how that would impact the conclusion of the valuation of a pharmaceutical company.
Okay, something
like that.
Also, like contingent consideration, Nate, for like.
Yeah, that's true. That's true, and that is kind of option-like in a way, and it's valued using option theory. But yeah, often when one company acquires another, you'll see an earnout that's structured, and that sort of bridges the gap between what the seller thinks they should be paid and what the buyer thinks that they should pay. They say, okay, well, tell you what, we'll pay this, but we'll give you an earnout. So if the company actually performs as well as you think it will, then you'll get more money. So there are contingencies involved there, such as like they might have to hit a particular revenue milestone or something like that, and things like that can be valued by using Monte Carlo simulation as well. So I know I'm rushing through this a lot. I did want to show one more thing, which is kind of answering that same question. Given that this produces a similar conclusion, why would you do this relative to a lattice or a Black-Scholes? And the answer, similar to the lattice model answer, is that it allows us to manipulate what happens at some point in between the start date and maturity. So say, for instance, we have a warrant that gives us the right to purchase the stock, but as an investor, we know that this company is very risky, so we want what's called like a most favored nations provision. So if the company happens to sell stock or sell a warrant to another company, and the exercise price on that warrant or the stock price that they end up offering to investors, if that ends up being more advantageous than what we got as investors, we want the better deal. So in this case, to say that hopefully more concisely, is that our exercise price in this case starts at 25 cents. We know that they're going to raise money at 3 points in the future. This is a pretty old model, so you'll see like 2015, 2016, 2017. Management has indicated, hey, we're going to raise money at these 3 potential future dates. And we want to be sure, okay, well, if you raise money below 25 cents, you'd better lower my exercise price. And so there is additional value with that right to have a lower exercise price if those fundraisings occur at a lower price. What I can do basically is simulate the price at each one of those points in time, and I want to make sure that I'm following a single path properly. So if there's a reset as of July 2015, if there's an adjustment to my exercise price, I want to make sure that that potential reset carries forward to March 31st if I'm looking at a single trial. So this is the other thing that Monte Carlo allows us to do. I spoke earlier when I was talking about the lattice models, how the individual stock price paths kind of converge in the lattice. So you actually can't do this kind of thing easily in a lattice model because we need to look at one single path that a stock price might take. Okay, so similar idea, one trial at a time. We're simulating what does the stock price look like at that first July date. Then if that's lower than our exercise price, reduce the exercise price. That's just what we're telling it to do. Then simulating the price using a previously simulated price as a starting point and constraining this by not only volatility, but also the duration of time between those two dates. What is the possible stock price at the next date, and does that result in an exercise price adjustment? And so on and so forth until we finally get to maturity, where we are going to calculate the payoff based on not the original exercise price, but the new one that this particular stock price path came up with. So I hope that makes sense. After we get to that point, it's very similar. We're just taking our payoff, we're discounting it to the present. We've done 10,000 trials. We're going to do 100 instances of that. We call those runs, and then we're going to take the average of all the runs in order to determine the results. In this case, we're valuing the same instrument as of 2 separate dates. So the inputs are going to change a little bit. Our stock price, you'll notice, has gone down. The term is going to shrink. But in this case, management's estimates of their fundraising dates have remained the same. So let's go ahead and run this simulation real quick. Hopefully I don't get an error. It's doing the same thing that the other model was doing. It's just doing it horizontally instead of vertically. I got an error, so I guess we'll only evaluate. I guess we'll only do the valuation as of one date. Apologize for that. I should have cleaned up this code first. So let's go back and look at the results. And I also computed the Black-Scholes result here. Hide that so it doesn't bug us. And this should kind of make intuitive sense in that if I have a warrant that gives me the right to purchase stock at 25 cents, but somebody else has a warrant that's starts out as 25 cents, but then has this most favored nations provision that allows the exercise price to be adjustable, their warrant is more valuable than mine. And so we should see that reflected in a comparison to the Black-Scholes, which we do here. So this is a good gut check that we value this appropriately.
Well, very good. That's impressive stuff.
Cool.
Yeah.
Thank you.
So guys, any questions you have for Nate at the moment?
In a litigation setting, does the Monte Carlo hold up as well as, say, a Black-Scholes or the other one that we did, the Bi-Nomial Lattice?
It depends, I think, on what type of litigation process we're referring to. I mean, it might be, you might have a situation where you're talking about some kind of a intellectual property dispute where you're looking at a damages analysis, in which case you might not, you probably wouldn't use a lattice model and you probably wouldn't use a Black-Scholes. You might use Monte Carlo, not in an option framework, more in the kind of sensitivity analysis framework to see, what could the potential damages look like for a particular company based on some kind of, IP infringement, where you might want to see what a possible distribution of outcomes would look like if you were to assume different rates of losses on revenues and things like that that might be attributed to the person's IP infringement, something like that. So it does kind of depend on the purpose of the valuation and whether or not you are looking at things in an option kind of framework. I would say typically for litigation, you're not going to see too much Black-Scholes or lattice models and you're probably not going to see Monte Carlo within an option framework, but you'll probably see it more in the lines of like a sensitivity analysis framework.
Very good. So Barrett, since we've still got your attention here for a second, I'm going to ask you to come off mute. Nate, thank you so much. I mean, this has been very helpful. May I have your email address, please?
My email address?
Yes.
Yeah, it's nate.hancock
Okay.
at scalar.io.
Very good. So thank you. And Barrett, these students are all graduating here in the next several weeks. They're entering into a job market that has a tiny bit of uncertainty built into it at the moment. And you've got some insights, I think, from having seen resumes and interviews from lots of students from lots of different schools. If you had a couple of pieces of advice to offer them as they're about to hit the job market, what would those pieces be?
One, this, the modeling that Nate just went through. Nate's the smart guy in a room, a bunch of smart guys that we go to when we can't figure stuff out. So if that was all overly complicated, don't let that scare you. That is some very high touch stuff. And I think the reason why I say that is in an interview, I wouldn't try to explain that you understand a binomial lattice model to the level that Nate just walked through. I think the biggest thing to think about is the inputs that go into it. If you can explain that you understand the concepts that would go into that, you can be taught to do that stuff on your own later on. A general concept of understanding why we would select a certain volatility or the reasons why a binomial lattice model might be more beneficial than a Monte Carlo simulation. Conceptually, that's easy. And so I think the whole point of that line of thinking was in interviews, speak to what you know and not try to sound that you know more than you can, or know more than you do at that time. It shows a solid foundation that you can build upon as an employer, rather than trying to teach someone who maybe thinks they know more than they do. I'd much rather teach someone who has a solid foundation and is willing to learn than someone who maybe has a flawed understanding because they tried to tell me, something that they weren't quite ready to explain. I don't know if that answered your question. I think advice is always tough. Interviews are, a roll of the dice, right? You may be better prepared one day than the other, and it just is, maybe you were more excited about one job than the other. I think looking back on my experience, the Excel skill set that I had going into the job hunt wasn't where it needed to be. I wish I had gone back and done learnings on my own, or taught myself some of these things. School is great, you'll learn some of it in the classes, but the people that I see that have exceptional Excel skills that I work with, a lot of it is self-taught or trial and error. And so, I think those skill sets were lacking, and I managed to get a job regardless because of maybe some of my soft skills or the potential that they saw. But I was definitely at a deficit when I started. So if you are given the opportunity to display those Excel skills in an interview, which sometimes you are, you want to make sure you hit that out of the park. So I think self-taught time, and collaborate with one another. It's Excel is not talk to your classmates and, hey, how did you do this? And they may have something that gets you where you got in 2 steps where it took you 8 steps. As I find out constantly at work, I'll ask a colleague to come over and be like, hey, how did you do this? And they'll show me, and they're like, how are you doing it? Yeah, that is not the way most of the do it. So I think especially in finance, if you don't have the Excel skills, it's definitely a deficit.
Well, I appreciate that. So again, Nate, thank you so much. Barrett, thank you. Please extend my appreciation to Cameron and Zach as well. And we appreciate your time today. We're going to go ahead and let you guys go so I can spend a few more minutes with our students before I let them go. But thank you and have a great day.
Welcome, you too. Thanks.
Thank you.
I think that Nate Hancock must be Scalar's black box. That's as close as I can come to thinking about what we just saw. And if you're sitting there thinking, I understand a little bit of this, then I'm proud of you, because most mortals wouldn't have understood any of it. And the speed at which he was moving through things and the detail at which he was going were impressive. And John and Pat, I expect at least as much from you next week, right?
Yeah, we're really going to blow you guys away. We're hoping to get a little deeper into those topics for sure.
Yeah, deeper. That's what we need. So, yeah. But I think for the rest of you, John and Pat will give some context to the utility of the Monte Carlo model that Nate didn't give. I think he might have already supposed that you had that context. So they'll give us some context. It'll make the reflection on this discussion a little bit richer, I think. And I know they're going to be prepared for that. So with that, any questions before we let go today? All right, guys. Well, again, thanks for being here. Thanks for looking so sharp. And I will see you next week, if not sooner. Have a good day.
Thanks, Rick.
Thanks, Rick. Take care.